In this video, I'm going to teach you about Heikin Ashi candles and a strategy that I use sometimes using Heikin Ashi candles. So I'm gonna just sort of tell you a little bit about Heikin Ashi candles. And so Heikin Ashi candles are a Japanese candle, and how they work is they average out the data. So they're calculated a little bit differently than the regular candles. They essentially smooth out and calculate average out the data so that you can very clearly see uptrends and downtrends. And so the biggest difference between Heikin Ashi candles versus regular candles is that Heikin Ashi candles actually will display trends. So you can obviously see trends with normal candles by drawing trend lines, that kind of thing. So if you wanted to see if this was in an uptrend, you can draw a trend line and sort of see the general trend that's going on. But with Heikin Ashi candles, you can actually see the trend right from the candle. So trends are represented in two ways. Bullish trends are represented by a flat bottom bullish green candle, followed by a second flat bottom bullish green candle. The general rule of thumb is two flat bottoms on any time frame you are working on, so 1 minute, 5 minute, 15, 1 hour, etc., is the start of an uptrend. So you see an uptrend starts here, boom, 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 boom. You see an uptrend starts here, boom, boom, boom. And you can see an uptrend starts here. A downtrend is shown with the inverse, two flat top red candles. So you can see right here, you have a flat top red candle, boom, boom. You see these two, so this signals the start of a downtrend. So that is basically the fundamental difference between Heikin Ashi and regular candles. Now, because Heikin Ashi candles are calculating average out data, they are somewhat delayed compared to regular candles. So you need to keep that in mind. When I personally trade with Heikin Ashi candles, I am trading with both charts open, a regular chart on one monitor and the Heikin Ashi on the other monitor. So the next thing that I want to teach you, and what I find very useful with Heikin Ashi candles, is its ability to identify reversal areas. So there are a couple of different patterns that I personally use quite a lot with Heikin Ashi to identify reversals. And so I'm going to teach you the three variations of the most useful reversal patterns and what they can mean when you're using Heikin Ashi candles. Now, these rules are more applicable for the ETFs, so SPY, QQQ, the Dow Jones, etc. But I have used them on other stocks like AMD, Boeing, etc. So they are applicable, but the rules that follow are going to be specific to the indices, so like SPY, DIA, etc. And I will be clear when I'm explaining the significance of a candle to indicate that this is really only applicable for the indices. So the first and most powerful reversal pattern on a Heikin Ashi chart is what I call a stagnation top. So a stagnation top is when you see candles like this, sort of spaced at equal lengths. So if you take your trend line tool on whatever charting platform you're using, and you look for where the wicks are conglomerating, you can see a stagnation pattern. So right here, it's not a very clear stagnation pattern. It's kind of jumbled, but you can see it's sort of starting to form a top stagnation pattern. But where you can see it very clearly is right here. This is a stagnation pattern, okay? And this means that we are about to see a pullback. We're about to see a reversal, which we have right here. The other patterns that I rely on quite a lot, and they're very prevalent on the 5-minute chart if you trade with 5-minute time frames, are the ascending and descending wicks. So whenever you see an ascending wick, which is these wicks that are wicking up, they're ascending. It's usually 3 to 4 green candles with wicks that are ascending up. This is a bearish reversal, and this signals a very bearish outcome. So if you see these ascending wicks, it means that the stock is going to reverse. So shorting is the correct answer, but it also means that it's going to be dramatic selling. Usually what it means is if you were going to draw out the pattern, you would get pullback, a move up at a lower high, and then a lower low. So that's generally what this tends to signal. Inversely, if you get the descending pattern, which we can see right here, you have 3 to 4 wicks descending. This means that you're going to generally see pullback, but you're going to see a new high from where these descending wicks are. So if you were to plot that, you would have a pullback, and then you would have a high that goes above this previous descending wick, which you see was the case here. And so just to review, you have ascending, which means that you're going to make like a lower low from wherever the day started. So here would be a lower low. So you can expect pullback to at least the low of the day. So we would draw a trend line from the low of the day. And then from here, we would expect pullback to the low of the day, which is right here. And then another bounce, and then pull back again. But on this second bounce, we see that it makes a descending wick, right? So we know that, okay, after this pulls back, we're likely to see a higher high than we see here, okay? So it's good to always watch these patterns. Now, you can also use ascending and descending wicks at the bottom. So you see, it's inversed, right? So you have descending wicks here. This signals that you're going to have a pullback to the upside, followed by probably a lower low. So how that would look in theory would be a pullback to the upside, followed by a lower low from where these descending wicks are, okay? Ascending is the complete opposite. We have ascending wicks. So we know that we're going to get pullback, but we're not going to make a new low, which was the case here. So when you're looking at this, you should be looking at it from both aspects. You should be looking at the bearish candles and the bullish candles. So it's essentially the information that becomes accessible to you in real time, right? So the first information we're going to get if we're actively trading this is we're going to see these descending wicks, okay, on the bearish candle. So we know inverse descending wicks on the bearish candle means that we're going to reverse back up, but that we're probably going to get pulled back down because this is a very bearish sign. So we can expect, if we're scalping, we can go long for the pullback, and then we're going to know that it's probably going to come back down and make another low, which it does. But we get that confirmation up here, right? So once we pull back and we see these ascending wicks, we have two things signaling that a new low is going to happen. We have descending bearish wicks, which generally indicate a new low will come. And we have ascending bullish wicks, which again signals the same thing. So we have two confirmations that we're about to see a lower low, right? We have here descending Heikin Ashi wicks here, and we have ascending bearish candles. Both of these signal that a new high is possible. Now, I'm not saying a new high of the day. I'm just saying a new high from this current price action pattern. So from this current little hump here, okay? So they're very, very powerful candles if they're used appropriately. Now, these rules about these new highs and these new lows are really only applicable to the ETF. So I've only ever really been able to successfully apply that principle to ETFs. This is my own strategy. I didn't learn it from anybody. I just back tested things myself. And I haven't found the kind of significance in other stocks. But these patterns still work for other stocks. So if we look at Boeing, you will see kind of similar patterns, right? So you can tell that Boeing tends to do a lot of stagnation. I know from personal experience. So let's see if we can find a stagnation. So we have like a sort of a stagnation. Oh, this is ascending. So we have ascending here, right? So this generally means that we're going to go up. And on the ETFs, it generally means we're going to make a new high from right here. It does actually do that, but it's not the rule. So it does it here, but it doesn't always do it. It doesn't do it as frequently as it does it with the ETF. So you can tell that there's a reversal here. You have the same thing here. You have ascending. So you can tell that there's going to be a short-term reversal, but not necessarily that it's going to make a new high. And you can see here, like this is a pretty bearish. This would mean that it would make a new low, right? A new low from this peak, which would be a new low from here, but it doesn't. So you can't really apply this rule to other stocks, but you can use it to identify reversal areas. So this is very clearly indicating that pullback is going to happen. This is very clearly indicating that we're going to see pullback as well. And this is very clearly indicating that we're going to see pullback as well. Okay. So if you go back to SPY, now that we've identified how to look at trends with Heikin Ashi and how to identify reversal candlestick patterns, the next thing we're going to talk about is how to set realistic target prices. So the most basic answer to that is essentially follow what the candles are telling you, right? So here is telling you we're going to reverse, but we're likely going to make a new low. So you can set your take profit probably at here. I would set my take profit probably just below the high of the day so far, which would be right here. So I would know to be completely out. I would start trailing this position personally at VWAP, but you know, every trader is different. So this is where this is where I would enter on confirmation that this isn't going to go lower. So on this candle here, once it starts pushing up, I would get in. I would start trailing. I would get in on the smaller time frame. So I enter on the 1 minute time frame, and then I would hold until VWAP. I would take some off, and then I would be ultimately targeting the high of the day or any other support or resistance that you have drawn from previous days. But if you want to do this on the larger time frame, right? One of the ways you can actually set realistic price targets. So say I want to swing this on the 1 hour. One way to set realistic price targets is to identify previous uptrends and downtrends and setting those as your target price. So if you see here, we have a descending candlestick pattern. This actually isn't a really good descending because it's only technically 2 candles. It needs to be at least 3 up to 4 or 5. So it's not really great. We do have one here, ascending, right? So if we remember, ascending means that we're going to make a new low from the current peak. So once we see that this is ascending, we identify the current peak, which is, you know, right here. You can set your take profit for the bottom of this peak, right? Which would be right here. This is where this peak starts. But you can also set your take profit for the start of the uptrend. So whatever, because this is a bearish reversal, we want to identify where the uptrend for this peak started, right? And so the uptrend for this, you do that by looking for the uptrend Heikin Ashi candles. So if we go over here, we see there's a flat bottom bullish candle followed by a second flat bottom bullish candle. So this is where the uptrend started that led to this. It's kind of like a consolidation, kind of like a flag pattern up here. but this is the uptrend that led to the formation of this peak. So what we can do is we can draw a target price line here, and this can actually be where we play the target price to. So if you see, we would get in on confirmation that it's not going to go higher, and we could take it all the way down to here. If we look at another one, what am I looking for? Okay, so if we look at another one, we can, let's see if we can find a stagnation. Okay, right here. Here's a stagnation pattern. So we have a stagnation pattern right here. Okay. So stagnation patterns generally don't tell us much aside from there's going to be a reversal. So what we can do is we can look at where the previous uptrend for the stagnation pattern has started. So in this case, you wouldn't be wrong to do it here. You're just, and this indeed would be where I would set my initial scale out. So, you know, we have 2 flat bottoms, so we can set our first target price here. But then we can look to see where the actual full-fledged uptrend started to get us up to this point, right? Because if you see, there's 2 peaks here. This is like a double top, sort of. There's a peak here and a peak here. So this really truly isn't the uptrend that led to this peak, right? These 2 peaks are essentially 1 peak. So if we looked back, we see, okay, here we go. So this isn't the start of the uptrend, right? Because these aren't flat bottom. This is a flat bottom, and this is a second flat bottom. So this is the start of the uptrend, this candle. You see that? Because it's flat bottom followed by a second flat bottom. Those 2 confirm the start of the uptrend. And look at this. You see where we found support? Right here. It's pretty cool, right? This rule as well is I've only really had great success with it with ETFs, not so much other stocks. AMD is the only exception. It does actually work well for AMD, but these generally are like QQQ, SPY, DIA kind of strategies. So please keep that in mind. Don't try to take this and play like AMC or something with it, because it's just, I haven't tested it with AMC. I've tested it with SPY, DIA, QQQ, and IWM. And they work fine. And so that's really the strategy. That is it. It's as simple as that. I mean, there's a lot of moving parts. There's a lot of stuff to remember, but just watch the video, take notes, and try it out yourself. And it works really on any time frame. You can use the 1 hour, you can use the 4 hour, you can use the 5 minute, 30 minute, 1 minute, whatever you want to use, you can. But it's really ubiquitous. It's useful for any type of time frame you wanna apply it to. So take that strategy for a test drive, see how you work with it, and always start with paper money first when you're starting to try a new strategy to see if it fits your style, to see if it works for you. Always start with paper money. Don't take somebody else's strategy and start immediately trading with it, because not every strategy is created equally. Not every strategy works for everybody, right? This worked for me. This is my own strategy. I developed it myself. But it might not be applicable to you. I've never taught it to anybody before. I don't know how well received it will be for other people, so I don't know. But if you found this helpful, if you actually have some success with it, please leave a comment below, because like I said, I've never taught this to anybody before. This is the first time I'm sharing this publicly. It's my own little unique thing, so hopefully you guys can find much success with it, and I really hope that this video was helpful for you. And thank you so much for watching. Please like and subscribe if you want. Take care.